Hey everyone, and welcome to this explainer. Right now, we're looking at a market landscape that has literally completely captivated the financial world. I mean, everybody is trying to decode these massive, incredibly volatile shifts happening in precious metals, especially as we look ahead to 2026. If you've been watching the charts at all, you know things are moving fast. So, today, we're going to break down the exact data, the technical footprints, and the historical sequences driving this market, straight from our expert sources. Okay, let's dive into this, because this right here is the ultimate investor question right now, isn't it? Everybody watching precious metals is asking themselves, do I buy gold or do I buy silver? Which one is actually going to give you the better return from here? Well, common wisdom out there often gets this exactly backward, and it ends up costing investors real money. So today, we're unraveling this mystery by looking at the actual data and the real structural sequence of the metals market.
Here's our roadmap for today. First up, the 2026 crash warning. Second, gold versus silver. Third, the precious metals sequence. Fourth, the silver ratio mechanics. Fifth, decoding the technical targets. And finally, strategic moves for investors.
Section 1, the 2026 Economic Crash Warning. Analyzing the macro stakes. You really can't understand the current precious metals market without understanding the broader economic fears that are driving capital right into it. And this quote perfectly grounds the whole narrative. Renowned investor Robert Kiyosaki recently issued a pretty stark warning about a potential global economic crash in 2026. He notes, I was just 18 years old in 1965 when I first invested in silver. Today, that makes me a successful investor. Today, his sources advise taking a really hard look at historical, hard assets like gold, silver, and Bitcoin as potential safe havens against traditional market weakness. Now, our sources objectively note several massive global challenges that are driving this 2026 crash prediction. We're talking about rising US and Iran geopolitical tensions. We have persistently high inflation paired with elevated interest rates, mounting global debt levels. We're seeing slowing growth in major hubs like China and Europe, and just increasing stock market uncertainty across the board. Look, whether or not a crash actually happens in 2026, these are undeniable pressures pushing investors to look for safety. Section 2, Gold versus Silver, Understanding the Fundamentals. Now, what's really interesting here is the contrast. With traditional markets feeling the heat of those macro factors we just talked about, capital is rotating. But where is it going? The difference between these two assets is honestly stark. Gold is the absolute first mover. It attracts massive institutional capital. In fact, we've seen record central bank buying of gold, literally $37 billion in Q1 of 2026 alone. Silver, on the other hand, is the second mover. It's much smaller, it's highly volatile, and it's heavily driven by irreplaceable industrial demand, like EVs and solar panels. They both have great stories, but they play entirely different roles. Section 3, the precious metal sequence. It's not a competition, it's an order. Here is the core thesis from our sources. These metals do not move in lockstep. It's a highly specific sequence. It's almost like a giant puzzle, and here's how it beautifully plays out step by step. Step 1, gold moves first. It acts as the primary safe haven, establishing the trend and validating the market. Step 2, because gold moves first, the performance ratio between the two metals hits an extreme point. Step 3, capital then begins to rotate out of gold, looking for higher yields. And step 4, that capital flows into the smaller silver market, causing silver to absolutely explode and consistently exceed gold's percentage gains. Let's trace the actual timeline of our current bull cycle to see this in action. In late 2022, the freezing of Russian assets triggered the initial flight to gold. Gold established the trend, ultimately peaking around $5,600 in January 2026, while silver hit roughly $121. Presently, we're in a consolidation phase. Gold corrected about 27% to near $4,500, while silver corrected far more aggressively, dropping up to 40% and sitting around $78 to $80. Section 4, the silver ratio mechanics, the springboard for outperformance. Okay, as we all know, the gold-silver ratio is essentially the ultimate pulse check on relative performance. It's a metric measuring how the two metals perform against each other. When this ratio expands, gold is flexing. It held its value better. But when it compresses, that is our historical signal for a massive silver rally. The most explosive silver moves happen right after this ratio re-expands and then begins to violently compress again. And here is the magic number right now, 62 to 1. During the recent correction, gold held its value better, so the ratio actually expanded from a previous peak of 44 to 1 all the way back out to 62 to 1. According to our sources, this means the recompression cycle, the phase where silver dramatically outperforms, is just beginning from this elevated level. But guys, it's not just the ratio. The physical market is absolutely screaming too. Look at these structural silver catalysts. We have incredibly low COMEX registered inventory coverage at 13.4%, high London lease rates at 6.3%. Physical dealer premiums are sitting at 12 to 24% above the spot price. We're in the sixth consecutive year of a supply deficit. That's a 762 million ounce drawdown. And critically, China has formally designated silver as a strategic reserve, adding price-insensitive sovereign demand. These physical conditions are vastly more intense than previous cycles.
Let's move to Section 5 and see how this builds. Decoding the technical targets, granular realities versus macro goals.
Moving from the macro view to the day-to-day charts, we have to talk about order blocks. Basically, these are specific price levels showing institutional trading footprints. They act as massive support or resistance barriers in the market, showing us exactly where the heavy hitters previously bought or sold. When we look at gold's technical charts right now, there is a massive order block target sitting squarely at $5,000. Our technical sources note that gold is currently battling some immediate resistance around $4,850 to $4,900. But if it can clear those levels, the charts point almost directly to this $5,000 block as the next major upside magnet. So what does that mean for silver? Well, let's do the math. No fantasy scenarios here, just pure arithmetic based on the ratio compression we just talked about. If gold stays at its current base of $4,500 and the ratio compresses just to 50 to 1, silver hits $90. If gold advances to that $5,000 order block and the ratio compresses to 40 to 1, silver hits $125. And if we see a historical extreme compression of 32 to 1 with $5,000 gold, silver targets an explosive $156. However, hold your horses a second. We have to ground these lofty targets with an objective short-term reality check. You can't just blindly buy and expect a straight line up. Current domestic and international markets frequently face retracements, flat momentum, and heavy resistance. Because as any trader knows, the market rarely lets you make money without testing your patience first. Short-term pullbacks and cooling off periods are completely normal, and honestly, a healthy part of the technical process. To illustrate this, let's look at some specific short-term domestic trading ranges from our sources. Now keep in mind, these specific figures are priced in domestic rupee markets. Analysts are seeing immediate downward pressure. For gold, they see a sell or retracement target level of 152,500 with a stop loss at 153,500. For silver, a retracement target of 263,000 with a stop loss at 264,500. This perfectly illustrates the actual daily volatility and cooling off that traders are navigating before the larger macro trends resume.
Section 6. Strategic moves for investors. Navigating the uncertainty.
So the crucial point is, the data points to incredible potential, particularly for a silver explosion. But how do you actually navigate this without losing your shirt in the volatility? Risk management is absolutely essential. The consensus advice across all our sources on how to survive potential 2026 volatility without panicking is incredibly consistent. First, maintain strong emergency funds outside of these volatile markets. Don't put all your capital into a single asset. Diversify. Adopt a long-term investment horizon. Always use stop losses to protect against sudden volatility. And of course, consult a financial expert before making major moves. We've covered the macro fears, the undeniable structural supply deficits, and the highly predictable historical sequence that moves capital from gold into silver. The data clearly shows that the ratio compression phase is just beginning. So I'm going to leave you with this provocative question to think about for your own portfolio. Are you positioned to chase the outcome after it happens? Or are you ready to buy the setup before this massive...
Disclaimer, this video for educational purposes only and not financial advice. Always do your own research before investing.